Class is in session. Welcome to Finance University, the only school where the tuition is free and the degree actually pays you back. I'm your Dean of Dollars, and today we're performing a forensic audit on one of finance's biggest unsolved mysteries, the equity risk premium. Yeah, we're going to crack open the case file on why stocks have, historically, paid investors so handsomely for taking on risk. Okay, let's dive right in. All right, our mystery ticks off with a simple fact that has absolutely baffled the brightest minds in economics for decades. You see, for over a century, stocks, the risky assets, have consistently and dramatically outperformed safe investments like government bills. It's kind of like a heist happening in plain sight, a huge transfer of wealth that, weirdly enough, none of the standard economic models can really explain. And here it is, Exhibit A, folks. For the last 130 years in the United States, the average annual return on stocks has been almost 7% higher than the return on so-called risk-free treasury bills. Now, this isn't some small discrepancy. This is a Grand Canyon-sized gap between what you get for being risky and what you get for playing it safe. This number, 6.9%, is the very heart of our puzzle. Now, just look at the sheer, absolutely mind-bending power of that premium over the long haul. Take a look at this table. One single dollar invested in stocks back in 1802 would have grown to over $500,000 in real terms by 1997. That same dollar in T-bills, a measly $276. That's not just growth, that is a hockey stick of wealth creation compared to the flat line of the safe stuff. It's just staggering. So, for a long time, this was just an accepted fact of the market. Stocks go up more, duh. But then, in 1985, a couple of academic detectives came along and turned this market fact into a full-blown cold case for the entire economics profession. They didn't just accept it, they asked why. And in doing so, they created a puzzle that, believe it or not, we're still trying to solve today. And here are our detectives, Rajneesh Mehra and Edward Prescott. Their groundbreaking 1985 paper, The Equity Premium, a Puzzle, basically put the entire field of financial economics on notice. They looked at the data, they looked at all the standard models, and they famously declared, hey, the numbers just don't add up here. And this, right here, is the core of their argument. The equity premium puzzle is simply this. Our best, most sophisticated economic theories can't explain that huge 7% premium, unless they assume investors are so terrified of risk that it's almost comical. We're talking about a level of fear that just doesn't seem plausible in the real world. The theory and the facts, they just don't line up. This quote from Mehra himself really just drives the point home, doesn't it? According to all the standard models, the extra reward for holding risky stocks should be at most 1%. That's it. So the billion-dollar question becomes, where in the world did the other 6% come from? So here is the central clue of our whole investigation laid out side by side. On the left, you've got what the theory predicts, a teeny tiny premium of less than 1%. And on the right, what the market actually gave us, a massive premium of almost 7%. I mean, this isn't a rounding error. It's an enormous difference that suggests our models might be fundamentally broken. It's why economists have been scratching their heads for the last 40 years. So ever since Mehra and Prescott blew this case wide open, economists have been playing detective, trying to hunt down a plausible explanation for that missing 6%. And this has led to a whole lineup of theoretical suspects, each one with a different story for why investors seem to demand such a high return for taking on risk. Okay, our first suspect is a really interesting behavioral quirk called habit formation. This theory suggests that our financial happiness isn't really about how much money we have in absolute terms. No, it's about how much we have compared to what we're used to having. Think about it. Getting a raise feels fantastic, but having to go back to your old salary? That feels awful. It's all about keeping up with your own past self. So, how does this actually solve the puzzle? Well, the theory says that after we've had a good run and our wealth is up, we form a habit for a certain lifestyle. If the market tanks and our wealth drops, that drop feels way more painful because we're falling below that comfortable habit level. This makes us extremely risk-averse right when things are bad, so we demand a huge premium to convince us to stick with stocks through those tough times. All right, our next suspect is, well, it's a bit more dramatic. It's called the rare disasters theory. This idea suggests that the premium we see isn't for weathering the normal ups and downs of the market, but for the tiny, terrifying possibility of a complete and total economic meltdown. I mean, think about it for a second. Our models are built on normal data. But what about the once-in-a-century events? The Great Depression, a world war, things that can wipe out a huge chunk of wealth. This theory argues that the 7% premium is basically the price investors demand for crash insurance. It's the fee they charge for being willing to hold stocks, even with that small but very real risk of a catastrophic loss.
So we've got our suspects, each offering up a different explanation. But this brings us to the fundamental question of the whole trial. Are stocks really that much riskier than bonds to deserve this massive, massive premium? Let's take a look at the evidence.
Now, if you look at this chart, the answer seems pretty obvious at first glance, right? Stocks, with a historical volatility hanging around 20%, are 5 times more volatile than T-bills. This is that mountain range of historical volatility everyone talks about. The swings are bigger, they're faster, and they are much more stomach-churning for sure. But hold on. Here is the critical question we have to ask ourselves. Is that short-term volatility, all those frantic ups and downs, really the same thing as long-term risk? I mean, if you're investing for 30 years, does a bad year or two really matter as much as where you end up in the long run? And that, my friends, is why the puzzle is still standing. While stocks are absolutely a roller coaster in the short term, history shows us that for a long-term, diversified investor, the risk of actually losing money permanently has been incredibly low. Investors have been paid an enormous amount for weathering those temporary storms, and the payment still seems way, way too high for the actual danger involved. The case remains open. Okay, so we've audited the academic debate, we've looked at the suspects. But what does any of this mean for you and what's in your portfolio? Let's translate this old cold case into some one-on-one level takeaways for your own financial game plan.
First, you have to acknowledge the risk. That premium is not free money. It's your compensation for enduring some real stomach-churning volatility that can make you want to sell everything you own. Second, you have to think long-term. History suggests, pretty strongly, that time is the great equalizer. It smooths out all that crazy short-term noise into long-term growth. And finally, number 3, question the future. The past is not a guarantee. Just because the premium has been huge for 100 years doesn't mean it will be for the next 100. And that brings us to our final provocative question. We've seen over a century where taking on equity risk was one of the single best financial decisions a person could make. But with all the new risks on the horizon, you gotta ask, will the next century be different? That's the bell for today, folks. If you want your financial degree to keep paying you back, make sure to smash that like button and subscribe to join the student body. To keep the lights on here at the university, check out our affiliate links in the description and the pinned comment. It's the best way to support the channel. Remember, we drop fresh knowledge every Wednesday and Saturday. Class dismissed.